Welcome to the ninth webinar series of Yashaswini for the women by the women held every Wednesday. And today's series is going to cover intricacies in Caro by CA Meera Joisher and issues in 15 CA and CB by CA Prerna Pashori. The moderators of the program are CA Apurvi Pyasi, CA Jasmine
Madam
Joshi.
Jasmine, right now
Yeah,
let me speak, then you can brief about all this.
sure,
Okay.
ma'am. So, yeah,
So,
welcome, Preeti Savla, ma'am.
hello everyone, and welcome to Yashaswini, an idol that is inclusivity, diversity, the outstanding performance, and all are the leaders of this profession and in all your endeavors. So, welcome all of you, to all my beautiful, wonderful women participants. And today we are having the session by Meera and Prerna on the topic of Karo as well as the 15 CNCB, and both the topics are very well thought and very important. And because statutory audits have started, and also regularly we are having this 15 CACB certification for the remittances purpose. And we have with us our moderators, CA Hetal Divani, CA Jasmine Choksi, CA Priyanka Gori. And I also invite you all to be the speakers and the moderators, being this the platform given to all of you to sharing your valuable knowledge. And all these sessions we are also keeping on our web portal. We are also revamping our web portal and coming out with more innovative thoughts, bringing the opportunities for flexi or part-time work to the women who have taken sabbatic and wants more assignments. So you can take up those assignments, and that web portal we will be relaunching on 29th of June, where we have CA Women Leadership Conclave at Mumbai at Sahara Star, and all the preparations have been made. So all the global leaders in the profession, we are inviting to our leadership conclave. And this is also by all women for women, our fraternity. Some innovative thought is there, because last year we have started with women awards, first time in the history of 75 years, and that will continue. And this year we are coming out with this leadership conclave, which will provide global networking platform and sharing of very innovative new areas in the profession, the work life balance, the entrepreneurship, or the job, or your practice to development and the growth of all these things. Yesterday, I have interacted with our Honorable Finance Minister, Srimati Nirmala Sitaramanji, and she has told that four things she has highlighted. And first is the top 100 firms, at least two firms to have like the big four, and that should be the Indian big fours. And that is how we want your thoughts on that. We will prepare one group, and you can contribute to that also. She has also told about bringing more inputs on GST. She has also told about lot of mutual recognition agreements with other countries for the development of the profession, where we can sit in India and do the practice in outside from outside India, the global, and that will serve the purpose with our leadership conclave. So I request all of you, we are launching it today, this global leadership conclave, right? So I request all of you to please enroll yourself, and this is way back, matlab at very lowest of the cost. You will get highest of the contribution for your profession. I wish all of you to reach to the newer heights in your professional life, and it is my endeavor to serve the best to my fraternity and women fraternity specifically, as a chairperson of Women Members Excellence Committee. With these words, I invite all of you and opening this ninth webinar series of Yashaswini. The Yashaswini mean that all are our successful women fraternity. So thank you so much and welcome all of you.
Yes. Shall we begin with ma'am?
Yeah, Jasmine ma'am, yeah.
Yes. So today the first speaker is CA Meera Joisher. And what can I say? It's she is the senior partner at RC Jain and Associate LLP. Her area of expertise includes statutory assurance and risk advisory, banking and insurance audit, internal audit, process audit, tax audit, trust and society audit, provident fund audit, internal taxation and cross-border advisory structure planning. And with such an expanse of knowledge, she is the most deservingly the face of her firm at various forums such as Bhanushali Chartered Accountant Forums, Saksham, Prerna, Women Entrepreneurs Learn to Lead, Mulund Study Circle, Women's Wing of JB Nagar Study Circle, WRC including all its branches, Vikasa National Insurance Academy, wherein she is a frequent faculty for training insurance staff on statutory audit of operating offices. She has also been part of WRC as coordinator for various sessions and courses. She is a co-opted member of Women Empowerment Committee of WRC and WMEC Committee of ICI, also a member of Core Committee of Women Entrepreneurs Learn to Lead, member of Core Committee of BCAF. Her few of many clients include New India Insurance, Nuclear Power Corporation of India, Mahanagar Transmission Company Limited, National Insurance Academy. Thank you, Meera ma'am, for sparing time and most importantly, sharing the knowledge and experience. We welcome you to the program. Over to you, ma'am.
Thank you so much, Jasmine, for the kind
Mira,
words.
one second, one more announcement also I have to make
Yes,
is that see,
yes.
we are also coming out with Independent Directors Conclave on 7th of June, Friday. So, women who are existing independent directors or want to be, that is, aspiring independent directors, can join this conclave. This is again at Mumbai at BKC, and we have very good speakers and very good structure. So all are invited and to enroll for this independent directors conclave. Thank you so much.
Thank you, Preeti ma'am, for your kind words and enlightening us with all upcoming events where we can participate and actually excel with the capabilities that we have. Thank you, WMAC, for giving me this opportunity to share my views. Uh, I'll directly jump on to my subject because I net have almost 45 minutes and the subject is vast enough to actually have a session of 3 hours. I'll try my best to cover as much as I can. I'll just share my screen. I presume my screen is visible to everyone.
Yes, ma'am.
Okay. I'll actually concentrate on basically some intricacies in Karo because Karo is in our life almost like breath, and we all have become experts in how to actually handle Karo, how to do reporting under this order. I'll just draw your attention to a special reference. One thing which we all do is we jump around here and there for what should be done for the classes, what clauses, what kind of reporting we should do, whether X should be reported, or I mean, but what we don't do is we don't touch the guidance notes that are provided by our institutes. And what I normally always suggest and follow is the guidance note is something like a Bible for us. It is given by our alma mater, and that is something which will protect us against every odds. So, and the guidance notes are prepared really well enough to cover all the doubts, almost at least 99% of the doubts that we all have in our brains when we are uh, doing Caro or any other activity. So the guidance note on company auditors report order 2020 is latest revised in July 22, which we can follow. And I can say we should not miss reading this guidance note before we take up any Caro reporting. What we will cover today is the applicability, few important points in every clause, and question and answers. The question and answers will be objective type, which are a part of your, you'll get a link for that. These are objective type questions where the participants joining webcast link where you'll have a link to these question and answers for session 1, that is mine, as well as session 2. My questions will open after my session gets over at 4 o'clock. You will have time to answer to those. Answers will be provided at the end of the session when both the sessions are over, that is around 5 p.m. Right? I will suggest everyone to attempt these questions. It will help you revise what we have just discussed in this next 1 hour, 45 minutes. The applicability of Caro actually was to happen from financial year 1920 to 2021, but finally from financial year 21-22 it has started. Due to Corona and several reasons, it kept on postponing, but we are finally into the new Caro order and we have to report as per this. All companies are covered except which are specifically exempted. These include the foreign companies also, which have a place in India and they conduct activities in India. All branch audits, I mean a company having branches within India, outside India, if it is applicable to the company, even the branches are required to report under Caro. All its license office, project office, even outside India will also be covered under Caro if the company itself is covered. Exemptions from Caro: the banking, insurance, Section 8 companies, one-person companies are clear-cut exempt. Small companies are also exempt. We'll come up with little bit of trickiness when it comes to small companies and the private companies. My RITs, that is my investment companies, CFDs, and the trust, foreign subsidiaries, these are all also exempted. One thing which I will want to put up is, it is like if you fall under any of these categories, suppose you fall under a one-person company, then even if you are a private limited company and the private limited exemption is not in your favor, you can still take an exemption under Caro because you are specifically covered under one-person company. If you are a small company but you don't satisfy the exemption criteria of private companies, it's okay. You still are a small company, you remain to be exempt under Caro. So if anything is specifically exempted under any one category, it will not be attracted otherwise, even if it is covered under any other category. What are private companies? Private companies are ones which are not a holding or a subsidiary of a public company, right? I mean, not a holding or subsidiary or a public company. Paid up capital is less than equal to 1 crore. Total borrowing is less than equal to 1 crore and total revenue as disclosed in Schedule 3 is less than equal to 10 crores. All these conditions are required to be satisfied. If any one condition, suppose I satisfy the first 3 conditions, but my revenue is 11 crores, I still am not under the exemption and I will have to go and go and prepare my Caro report for that particular company. And the status of this 1 crore, 1 crore, 10 crore is to be checked as on the balance sheet date. Why I'm mentioning over here is, you will feel why I'm specifically putting it in red that it is on balance sheet date, because there are some other criteria in the upcoming slides where you will find that you have to check it for maybe the previous year or maybe something during the year and not as the balance sheet date. And that is why, at least in private companies, make it a point that the status needs to be checked as at the balance sheet date. Private companies. Private companies, where when we talk about borrowings, when I told borrowings should be less than equal to 1 crore, what is borrowings? So borrowings are to be considered as the outstanding amount at any time during the year. Suppose at the year end, my outstanding is 7.5 crores. But during the year, it touched 11 crores. It is 1 crore. So suppose at the end of the day, it is 75 lakhs. But during the year, it was 1 crore 5 lakh rupees. I still am not exempted and I have to do a Caro reporting. the borrowings have to be from a bank or a financial institution. If any private borrowing is there, it is not covered under this category at least. It would include any kind of interest which is accrued and due, but an interest which we provide at the year end. Suppose in case of a term loan, my cycle is Jan and June, Jan and July, 1st Jan and 1st July. As on 31st March, I book the interest from Jan to March, but it is not due. It is accrued, and we, as per the accrual principles of accounting, we put it in our books. That portion of interest will not be included in my borrowings. But suppose as on 1st January, suppose on 25th January, there was this interest which was required to be paid. It is accrued and due, but I have still not paid it till 31st March. It is lying in my liabilities, in my balance sheet. It is to be added to my borrowings to calculate the 1 crore limit. It will include any kind of credit card dues, current maturities of long-term borrowings. The current maturities of long-term borrowings I'm specifically mentioning because we generally mention those under current liabilities. We don't mention it up in my borrowings, and hence we tend to miss out that. So ensure that all those current maturities which are lying in my current liabilities are also added to borrowings before I end up checking the 1 crore limit. Reserve, when I'm talking of 1 crore of paid up capital, it is paid up capital plus reserves. And the reserve will include almost all type of reserves. Let it be a capital reserve, let it be a revenue reserve, everything is to be included. So my basic capital, which is can be any type of capital, including the bonus, shares, etc., but the paid up, plus all types of reserves taken together. If it is less than 1 crore, I enjoy the exemption. It crosses 1 crore, I do not enjoy exemption under CAR. Small companies. Now, small companies, if I talk about private companies, my limit of paid up capital and reserve was 1 crore, whereas in case of small companies, it is 4 crores. And the total revenue under the private company was 10 crores, here it is 40 crores. So the limits are almost, I would say, 4 times. Here again, both the conditions are required to be satisfied. And if it is a holding subsidiary, Section 8, governed by a special act companies, it cannot be considered as a small company, right? So irrespective of then, if this company is a holding of a very small company, the holding itself has maybe just 1 lakh of paid up capital and reserve, the total revenue is hardly 5 lakh rupees, still I cannot call it a small company. I'll then have to just exclude this small company criteria and go and check for my private company criteria, right? The status here again is to be checked as on the balance sheet date, and a turnover to be checked for the immediate preceding financial year. Please ensure here when I'm talking of the turnover, in case of private company, my turnover was for the very same financial year where I am checking for CAR. But when I talk of a small company, I have to check the turnover of the immediate preceding financial year. So there are within CARO, within these company definitions, there are these small changes which we might ought to forget or miss out. And that is why I've just put up those that please remember and accordingly take decisions. Special points which we should remember while we are doing CARO reporting. The audit report, see, a normal audit report, if we are talking about, there is a standard format, and our observations, if are negative or qualified, it is only then we put up those observations. Otherwise, we just give a clean report stating everything is good, this is management responsibility, this is auditor's responsibility, and everything is true and fair. But as far as CARO is concerned, we have a set of almost 21 points, major points with these sub points. And we need to report specifically for every point. Even if it is not applicable, we'll mention why it is not applicable and then state for this reason the specified clause is not applicable. And hence we'll not report anything further on that. But the mention still is required, right? The good part of this is that I don't need to travel beyond those 21 points. Unlike my audit report, wherein anything and everything on the earth is to be covered if we feel it is a negative comment. Right? Caro applicability to be checked year on year, and not like once it became applicable, I have to always keep on reporting on Caro. No. Section 25 companies. See here, you would have seen that Section 8 companies have a mention at many places. Right? The exemption itself has a Section 8 company exemption. But it does not have any mention about a Section 25 company. However, the guidance note states by the provisions of Section 465 of the Act, that is the Companies Act, the exemption as given to Section 8 company continues for Section 25 companies also. It is like a vis-a-vis. Then when we talk about when we are doing a Caro reporting, there is a point when we talk about proper records throughout the year. So it's not that the entire year they did not have anything. They made up those X records on 25th of March or 31st of March. They produced before us, and we mentioned that everything is in place. We have to exercise our professional judgment to ensure whether that particular record is good enough to give me the entire information for the year, and it was otherwise okay not to have it on those respective point of times, then I can accept it and not comment upon it negatively. But otherwise, the maintenance of the records at each point, under each clause, are required throughout the year and not just at the year end. Second, when we talk about Caro, it's something like a normal audit that we are doing. Here also, reporting under the 21 clauses will be like a reporting of an audit and not as an investigation. We are auditors and not investigators or a CID wherein we need to go and dig for something and specifically come up, then this is a problem. A professional judgment, open eyes and ears, giving us reasons to believe if something is wrong, we definitely need to take up, but not as an investigator, just as an auditor. Caro is not a separate assignment like a tax audit or a GST audit, something like that. It is a part of my existing statutory audit. So there will be no separate assignment letter, engagement letters, etc. to be exchanged in case of reporting for Caro. While we are reporting or analyzing for the different points under Caro, we need to comply with all the accounting standards, the way we do it when we are doing it for my main audit report. All the accounting standards, including that of documentation, work of another auditor, etc., XYZ, all those need to be continued to be followed here as well. Interaction with management is very important because most of the points which we need to report on under Caro, and in fact for any other audit also, the management inputs are very key to us. What they need to say about what's happening in the company, etc. So definitely before starting, during the course of audit, and even an exit meeting should be arranged with the management. But when we are reporting, report the facts, report it independently. Most of the time what we do, we are trying to cover up the management's words. Management is giving us some explanation and we are just copy pasting it in their words, in their favor. It's okay if you want to do that, just to be not very harsh or something like that. But very frankly, we auditors are not required to be a goody person. We need to put up facts, right? We don't need to cover up what the management is saying or what the management is doing. Most of the points under Caro, I would say some around 50% are pure statement of facts, while the rest of 50% require an exercise of our judgment as to what we feel about that situation, what we feel the company is doing. So we need to be judgmental positively after making all right analysis. And we need to ensure that there is materiality. if we have certain issues and it is as small as say 100 rupees or 1000 rupees in a company having crores of turnover, or maybe 1 lakh rupees having a turnover of 1000 crores, I might end up being very silly. That 1 lakh might not be material unless it is something related to a fraud, something which is fraudulent, something which is proprietarily wrong. Then I would not consider materiality even for 100 rupees. But otherwise, whenever reportings are happening and a couple of clauses are there, order is materiality. So based on that, we just need to report. Reasons for reporting unfavorable, qualified, or disclaimed opinions. In case we are giving any kind of unfavorable reporting, unfavorable opinion on something, points, I should mention the reasons and have documents for the same with me as working papers, so that in case there is any question later on, we are able to substantiate what we have mentioned. This is something we always miss. I always stress upon documentation as the prime responsibility, and unfortunately, we consider that as the most last responsibility, and most of the time don't even do that. Don't make that mistake. That is the only thing that is going to save my skin in case of any adversity. In case you are making any unfavorable comment not resulting in qualification, even then at least mention that this is the kind of unfavorable instance that is happening, but it does not affect my true and fair view, or maybe it is not material or something like that. Just don't mention it and leave it, or don't put up generic replies. If I have any adverse comment having a bearing on true and fair view, very clear cut drafting and 100% documentation. Auditors comment to be specific, meaningful, and complete. Put up facts and not explanations covering up the management. Indicate the information and explanation which is not available. Sometimes you have to report on X transaction, but the management is not making you available those kind of records. You are not able to check. Put it up clearly. See, please don't try to shade the management, because in case of an problem, they are not going to come to our rescue. Right? Today, we will always be good that management should not be into trouble or questions, and that is how we just sugarcoat or window dress the report. But later on, actually, if there is any case of negligence or someone who's fired, and today this is very much possible, right? Especially with public companies and these big private companies, the perspective which the founders initially had, that this name is like God to me and I will not do anything to taint the name of the company. I think that has gone, that has vanished in today's world, and it's okay. So what we need to do is we need to be very, very cautious when we are doing an audit, when we are reporting. And certain paragraphs, if they are not applicable, mention the reason why they are not applicable with a conclusion for XYZ. This paragraph is not applicable to the company. For drafting, we have very beautifully drafted window dressed paragraphs by our big four auditors. I don't want to put it negatively, but definitely at some points we find that statement of facts would have been a better thing, but at the same time we should learn how they are drafted, because in certain cases if you don't want to or you're not able to put up the facts as crisp and clear as they are, you can take shelter of such kind of draftings which they are doing, and the guidance notes have given a lot of idle paragraphs which we can use when we are reporting on car. And this documentation in bold red, which is very important. Let me jump directly to the reporting paras, right? Now, my clause 3 talks about reporting the points which are required to be reported under Caro. And if I go to my clause number 1, it all talks about maintaining good records. Is the company maintaining proper records showing full particulars, whether the company is maintaining showing full particulars of intangible assets. So these are fixed asset related records which are required to be maintained. Initially, reporting for intangible assets was not there, but with the new Caro, this is very much in place, and we need to report on my regular PPE and my intangible assets. It's a matter of professional judgment as to whether we feel the records maintained are appropriate for the size of the company, etc. And if we feel they are not, you may just mention it. The records, generally today what you find is things are kept under Excel. Initially, when we talk about fixed asset register, we had the old thought people like us, we had this big register having n number of columns, and you just keep on scratching and overwriting, and most of the papers are torn. All this is a very old story. Today everything is kept on Excel. But the problem is with Excel, you can very easily alter what is mentioned over there. Someone can come and just delete certain row. Someone can go and add something in between, which was not possible under the traditional old fixed asset register. If I needed to do any backdated entry, I couldn't go back and write anything over there. Today it is possible. So firstly, check the Excel which you're talking about is reconciling with my books of accounts. Secondly, that it is complete, accurate, and secure. How do we check of completeness? One is the cross-tallying reconciliation will help me ensure I would say, or put in at least get a better assurance that it is complete, accurate, and security. How do I place my reliance on that there were no backdated entries, backdated inputs in that register, etc. So there are concepts wherein the Excels can be locked. You cannot put in any new Excel. Again, the admin of that Excel can do everything, right? But at least a common employee handling that document will not be able to do that. So my cells, my rows, columns are locked. I have a security password which is available only with the designated people who are responsible for that register. That will give me a bit of assurance that it is accurate and it is secure. Initially, the fixed asset register was in certain specified designated place. No one could go and access it every single day. But now with the change in technology, we have to come up with changed methodologies. In case of movement, numbering, whether it is appropriately happening, wherever my assets are lying, I'm able to identify that. And if they are very, very small, if I'm talking about 100 mouse lying in my fixed assets, I need not make 100 entries, right? So then I can do a clubbing or grouping of those small individual value items or same type of useful life of assets. That is allowed. First, as I told, was whether proper records of those four fixed assets are there. Next is whether physical verification of the assets is adequate and whether it is happening, whether it is appropriate as per the size and nature of the business, right? So what can be, how do you check that? So how do you check is what generally we do is we take an MRL stating yes, we are doing it. See, MRL, I'll talk about taking an MRL at least 10-15 places in my entire presentation. But this is something which we think is like universe. MRL ले लिया ना, अभी मेरे को कोई touch नहीं कर सकता. Do we really think this is possible? This is just a piece of paper जिसमें किसी ने कुछ लिख के दे दिया है. Can I hold this MRL in the court of law that management has signed X is there, and now if it is not there, hold him negligent and not me? No, na. Whenever I am putting reliance on any paper received from a separate party, I need to have my checks done, right? Standards of auditing. I need to check whether I can place reliance on that? Do I have any other cross checks to ensure what is written in that is correct? If I had reasons to believe what is written is not correct, I cannot just take away myself stating that MRL mein likha hai nothing doing. Whatever is stated in MRL, we just blindly follow. I have to do my checks. If there was a reason to believe that fixed asset verification was not done, I should go and do further checks to ensure myself whether it was done or not. There should be adequate evidence for conducting physical verifications, and only MRL will not work. And in few cases, in bigger organizations, I should be a part of that physical verification. I should do a self-observation. If not 100%, at least I should ensure it is happening. And it is happening in the right way and right type. Whether the method adopted is reasonable. Whether it is at reasonable intervals. Suppose I have very limited stock, or maybe I have big sized machineries. The per unit is very less. There you can do multiple counting during the years, etc. Also, but when I talk about maybe large number of stock, and I do have other internal controls, in those cases doing it once in a year, maybe once in 2 years also doesn't matter, right? Reasonable interval does not mean it has to happen every year, but I should ensure that as per the requirement of that particular organization or that particular type of business, whatever they are adopting is good enough. And if there is a discrepancy, the materiality when I'm reporting, and if there is something very small, definitely I can just overlook it. Don't leave assets not obviously verifiable. For example, if I go into a electricity company, who have the transmission companies have huge assets in the form of cables under the ground, can I go down and keep on checking it? Leave aside once in a year, once in 2 years, once in 5 years. In once in 50 years also, will I just dig it, check, measure the length of cables that are there below? Not required, right? I can have a overall check of, okay, from here till position Y, what is the distance? A Google distance maybe you can do. And if there is connective, I mean the electricity passed from here, and at location X that electricity is received, definitely those wires or those cables are there. That is why they have received it, right? So if even if it is not obviously verifiable, some common sense can be applied, and we can ensure that these are there. Same for the overhead, the current lines that are there. Suppose you have something like fuel that are there in huge storage tanks, you can't keep on measuring, but how? And you can't remove that material out to measure it. So in that cases, you have different scientific methods depending upon the physical things, the size of the tank, the height, depth, diameter, and then we have those sticks going below to find the level. We measure that. So with different type of stock, different types of assets, we need to just ensure what type of method to be followed and common sense to be applied. Audit is at the end everything related to just common sense, right? Now, by subclause 3.1c talks about verification of title deeds. Title deeds can be anything, a deed or a document which will prove the ownership of that asset with the particular company. If these deed is with any third party, maybe they have secured any loan, I mean they have procured any loan against security of these assets, the same will be lying with bank, something like that. In those cases, get a third party confirmation from the bank that these documents are lying with them, and the company is the owner of that particular asset. Legal, suppose there are lost title deeds, I should mention in my report that I couldn't find it and the management says it's lost. And this is something very negative, because I can't just mention on it is lost. I should have some, if I lose a simplest phone, I go and file an FIR, right? So if big title documents of assets are lost, I need to go and do something to replace or have some new documents in place of that. I can't just sit upon stating my documents are lost. Right? So even before we are mentioning that these documents couldn't be found and they are mentioned to be lost, I need to have my checks that what else they have done to ensure that this loss can be mitigated. And something that will prove that these assets ultimately belong to them. The legal determination, how the validity of these title needs, I don't think I need to go that deep to find whether what is written and whether that really makes this company the owner of the, if there is any legal flaw in that document, I don't need to go and do investigation in that. I just need to apparently ensure that these title deeds are in the name of the company. And if not, I have to mention over here. In several cases, you find there are disputed or pending court cases in case of some asset, maybe especially the lands, buildings, etc. And as a result, the documents are not transferred in the name of the company. I can accept this explanation so long as it is maybe 2 months, 6 months, 1 year. But there are instances where in the same thing we mentioned in the Caro report, and then there are instances where go on for 20 years, 15 years, 5 years. I mean, see, if it is disputed, then there are very high chances that they already knew all this is in place. They just wanted to siphon the money off, and hence all this asset is shown in their books, but actually we did not receive the ownership. So exercise professional judgment whether there was any kind of diversion. Then if we find if a particular asset is held in the name of any other person, which is very common, especially in case of vehicles. Vehicles are held in the name of directors. Why? Because otherwise the road tax is very heavy. Right? So at least there should be common sense evaluation of that asset still belongs to the company. It is only for certain practical reasons and that too I would not say this should be accepted in case of very big companies, because then we should be putting our statement stating that no, even if it is higher road tax, it should still be in the name of the company and not in the name of the director. Investment property held for disposal also to be included while we are reporting under this clause. Revaluation of assets, whenever it is happening, the valuation should happen. I should not do it on my own. I felt this is not 1 crore, but this is worth 5 crores. I just revalued the asset, put 4 crores in revaluation reserve. No. There should be a basis for the revaluation, and it should be with a valuation through registered valuer. If any one particular class of asset should be together revalued. It should not happen that suppose it is land, I'm revaluing 2 lands but not doing it for the rest of the 4. So that should not happen. Okay, I will not maybe probably revalue entire set of assets, but a class of assets should be revalued together. And materiality is required, wherein they have mentioned that if there is a change, if the revaluation is 10% or more of the total net carrying value, then I need to report on it. 1E talks about Benami property, whether any proceedings have been initiated, whether appropriate, and that proceedings have been appropriately recorded in the books or in the financial statements. Legal expense. And firstly, here the major problem is how do you come to know there is a Benami property related proceedings which is initiated? There are chances in few cases wherein the management will truly disclose everything, but they may or may not. Again, this is very common in case of any kind of legal matter, right? And you also know for such cases, what we do is we keep an eye on the legal expenses, professional expenses, any kind of miscellaneous wherein they they have all clubbed and put together in one bundle. A minute scrutiny of those kind of expenses will bring me to certain legal case which they are trying to hide from me, and maybe from there you can get this Benami property disclosure as well. And MRL to be obtained to just cushion ourselves, right? My 3.2, which talks about physical verification of inventory. The way I did physical verification of assets, I should do physical verification of inventory as well. And what it generally talks about is verification of material items is okay. Suppose you're missing out certain small items which are maybe 5%, 10% of the total, and you are not verifying those physically every year or on frequent intervals, it's okay, right? Again, professional judgment exercise is required. The periodicity and reasonable interval can be 3 months, 6 months, 1 year, 5 years, depending upon the business. What we need to ensure is that this physical verification has proper coverage and the procedure adopted is correct. It should not just be an eyewash. Materiality already specified. Suppose in this physical verification, you find a deviation, and the deviation is more than 10% of each class of inventory, then I need to report on it. And this 10% is to be calculated on a net basis. That is after adjusting the positive. That is, I suppose I have some extra stock, I have some shortage in stock. They need to be adjusted against each other. The amount which is left, match that with the total inventory. If it is 10%, I need to report, else I don't need to. Then physical verification point further talks about how they have dealt it in the books of accounts. Suppose there was a deviation observed and they've recorded in the books of accounts. I just make a mention that there was this kind, and why I need to make a mention of why it is important for me is if there is a deviation means my internal controls are not correct. So my dependence on the internal controls will change now, right? And they need to record that discrepancy in the books of accounts. If they have done so, it's okay. If not, the impact of not recording thereof on my financial statements also I need to quantify. Got it? An annual reconciliation of an opening purchase, consumption, etc. in correlation to the production should also be done, because that will help me determine whether the records put in front of me are accurate or not. Right? Because the completeness, I don't have any other way to find out. Suppose there was certain production which was just sold off of the records. I did not come to know. But when I know putting in 10 units, I will get back 9, one being my normal loss. So every time I find the input of 10 is going, I should calculate 9 as has come out, and whether that 9 is reflected either in my stock or in my sales. These kind of checks will help me determine whether the completeness is there in place or not. This clause is applicable even in case there's a third party inventory in my premises and I'm using that inventory for certain loans or keeping it as security. Then I need to check it and I need to report under this. And in case my inventory is either in transit, it is with my job worker or somewhere else, I need to either go there and physically verify or get third party confirmations from them if I cannot physically verify. And if that particular entity is keeping any online records, I should physically log into that portal and check the details, take out what is there on the year end. Verification of small material items, periodicity. I mean, this is almost similar to my previous clause. Okay. Working capital limit, that is my 3B, 3.2b, talks about stock reporting discrepancies. Here, what is important is when this materiality, when they have said I need to report, I mean, what I need to report? What I need to report over here, if I go, it basically talks about for kind of any working capital loan, I need to give quarterly statements or monthly statements to the bank stating this is my stock, these are my debtors, these are my creditors, etc. What I need to do is check the statements that have been submitted to the bank are in line with what is there in my books. You all know that the statements are hyped up and given to the bank so that my DP is very much intact and I can make my best utilization of the limits that are sanctioned to me. But in the books, the amounts will not match with those statements. If that is there, I need to specifically mention it out over here. And when I'm talking about mentioning, I need to mention only in those cases where my working capital limit is 5 crore or behind. Right? And when I'm talking about the checking of 5 crore, it is the sanctioned limit and not the outstanding balance. Both my fund and non-fund based limits are to be clubbed up together to check for the 5 crores at any point during the year, not the end. At the year 5 crores, but during the year this in total was more than 5 crores. I still need to report on this para. No audit, but just comparison of statements submitted and balances in the books. Right? I just need to match X with Y. If there is discrepancy, I have to report. I don't need to go further to do an audit of what is reported is right or wrong. Which part is right? The books are correct or the statement is correct, nothing doing. I just need to disclose the discrepancy. Consider the materiality and the relevance of the discrepancy. And there is one question. What during the year, every quarter, the statements were submitted. At the year end, those statements were resubmitted. And the resubmitted statements do completely match with my books of accounts. What should I do in such case? Should I do reporting or I should avoid because now it is matching? So here what experts opine is the intent of this para is to ensure there is no eyewash. In June quarter, I gave certain statement which has been hyped up, right? And based on that, my DP was managed. In the month of March, I re-give that statement. Initially, I had given it for 150 crores. Now I am giving it for 125 crores. Are they going to go back, change the DP and charge me extra interest? None of the banks do that. They don't even understand it, right? So here the resubmissions by itself are not going to serve any purpose. So according to us, according to me, even if the resubmitted documents match with my books of accounts, I should mention that the original documents did not match. There is a discrepancy. Loans, investment, guarantees, and securities. Here, I have to comment on any loan taken, any loan given, investment made, guarantees given for someone during the year. Nothing. If I have no transactions during the year, only opening is standing as it, I don't need to report on that. But if there are any such transactions during the year, I need to report. Put up factual figures, including those which are taken and repaid within the year. The squaring off is also happening. Still, I need to report along with the relationship of the payee or the beneficiary entity. Suppose I'm doing it for my subsidiary, joint venture, all those kind of details are required to be given. It is factual disclosure of all the numbers. But if there is a normal advance against any order, the management tells I need to provide them X, and that is why they've given me an advance. It is not to be covered under this, but you find that an advance is there in your books for last 2 years, for last 5 years. So then that is just a professional judgment as to whether I should accept that it is a trade advance or I should consider that as a loan. Here I'm talking about loan given, sorry. Right? But again, I would say if I've given something as a advance for an asset which requires 5 years actually to be made up. It is a very complex asset and it requires almost 5 years to be made up and delivered to me. I've given them advance while booking that particular asset, right? In that case, again, I would not say only the length or periodicity, since it is very long, I should report it over here. So it should actually depend on in accordance with trade practice. If my trade practice is to give advance, then it should be there. Again, yeah, it is a very small kind of goods only, but there is no general practice in trade to actually give any kind of advance over here. But still, I have gone ahead and given an advance. Then I have to ensure it is really an advance and why there was something done against the trade practices. And if I feel there is anything fishy, I report it, otherwise I don't. But here again, a lot of professional judgment is required, wherein these advances kind of there, which they talk about against my business, my trade advance. All types of loans, which include my secured, unsecured, short term, long term, whether in cash or kind, everything is to be covered. And only financial gar- and guarantees ensure compliance with all these company law sections 71, 79, 81, 80, 85, 87. They give a list of do's and don'ts. We have to ensure those do's and don'ts have been followed when all the transactions related to loans, investments, guarantees, securities have been done. And how do we check whether this has happened? So for that, you can just run through the minutes book of the board, the general meeting, Schedule 5 of SEBI, LODR, regulations, etc. And take an MRL for the kind of guarantees, because that is something, see, for everything else, actual money is going to come and go, except a loan or an advance in kind, actual money is going to travel. So it is a bit easier to check. But in case of guarantees, you'll never come to know. So try whatever you can hunt from these papers which I've talked about, and also take an MRL from the management. Uh, the admin team, how much more time I have, because see, Caro is very vast. I will not be able to cover entirely. So depending on the time that you let me for, I will continue that much. The presentation, however, has everything, so can be circulated. The admin team, technical team. I'll continue at so long they don't stop me. Okay. The next the disclosure is about these loans, investment guarantees, etc. Whether the terms of any of these are prejudicial to the interests of the company. What do you do for that? Firstly, you check all the prior approvals of the financial institutions, the rate of interest prevailing in government, to compare the interest that we are charging or the investment opportunities that we have entered into, whether they are line with my other similar options and they are really giving me good returns. Not only interest, but all the terms are required to be checked: the securities, terms and period of repayment, the ability to lend, borrower's financial standing, the credit rating, non-availability of alternate sources of finance, urgency of borrowing, restrictive covenants, nature of entity. These are certain parameters which will help me build my professional judgment. This is a pure professional judgment related disclosure, and these are certain criteria which will help me in that. For investment made, check whether the company where we have invested really has the ability, and firstly whether I have the ability to invest, the standing of the investee company, whether I am not just wasting, or maybe this is a very good route to siphon the money also. I say it is an investment, it is just lost. So the standing of the investing company, the source of fund from where I am actually going to make this investment, valuations of the investments, loan to the so these are all again parameters to check whether the investments are in good terms and they are not prejudicial to the interests of the company. The loan to the employees cannot be said to be prejudicial to the interests of the company, even if they are interest free, because they are as per the terms of the policy. A capital or a loan to subsidiary which is loss making, we might consider it is not prejudicial. I mean, it is prejudicial to the interest, but I would say many a times, being a holding company, you might need to stand by your subsidiary. And unless a subsidiary is actually just making losses and it is a eyewash to siphon the money off, but a plain investment in a subsidiary which is making losses might not always be prejudicial to the interests of the holding company. Here, whether next reporting, when I'm talking about whether any of these are overdue means I had paid, given some loans and it needed to be repaid, or maybe I needed to be repaid after 6 months. Here, what I need to mention is pure statement of facts. This is the repayment schedule. These are the dates. These are the overdue amounts. Since this much long, it has not been paid. No professional judgment in that. In case the schedule of repayment is not given, clearly state that this kind of loan does not have a repayment schedule, so we are not able to comment on it. The amount should be mentioned, and since when it was given. If there is a demand loan, you mention that. And if it is overdue, then whether reasonable steps have been taken by the company to recover that amount. That will actually let me know whether it is prejudicial or it is done only to siphon the money. Right? Diversification, which I talk about. Many times you find you have taken loan and then you have given it to your sister concerns, which is diversion of funds. The loan terms will not allow you that. So that is something which we need to check over here. And how do we come to know this overdue? Suppose I've given some loan to X, Y, and Z, 3 people, and they're not repaying it back to me. I'm also sitting silent. I'm not bothering even to go and ask them, which gives me a clear indication it was being given over there and I'm not bothered about it. Right? Suppose there is any restructuring that has happened. There were certain old loans. To repay those loans, new loans have been taken, or the existing loans have been just renewed. All those kind of reporting I need to do over here, just to bring to the notice of the reader of financial statements what's going on, because on the face of the financials all this is not visible. This is basically why all this restructuring needs to be brought out separately under this clause. Adherence to some specific company law provisions which they talk about. So minute scrutiny of that section, what the section says, read it minutely, just ensure that is happening. If not, report it and you are done. But this is to be done in case of this kind of reporting is not required in case of exempted deposit. There are several deposits which are exempted. I mean, public, when we talk about this public deposits, there is also a reporting under the MCA of these deposits, but certain deposits are acceptable and they are exempted. If we have deposits which are only exempted, then I will say this clause is not applicable to me because all these are exempted deposits. And if you find there is something fishy over there, I need to check whether the internal control systems are working properly, and so that this diversion is not happening. I've just accepted certain monies from some people lying in my balance sheet and I'm not repaying, I'm not reporting as deposits. All that should not happen. That is why auditor is required to specifically comment. Cost records. See, cost records is something which seems very easy but very frequently missed out. Reason being, again, cost record is something which is maintenance of which is based on their turnover and capital, etc. Till last year, it was not applicable, right? And we tend to just copy paste. No cost records are maintained right over here, and we just let it go. Or reverse also has happened. For example, in our case, here it was written cost records have been made, maintained, everything. But when the reporting had to happen in my MCA under my forms, I ticked no cost records were maintained. Right? So don't end up making those small clerical errors. Ensure the parameters and I mean the eligibility limits under which the cost records become applicable. Comment on whether they are made and whether they are maintained. They made the record and kept it, but they never made any entries. They did not maintain it. So I need to mention. And an upfront reasonableness of the same, whether the records which you find majorly those entries are made based on your general audit of the books of accounts. I need not go minutely into investigating whether every entry is correct or not. That the cost auditor will do if it is required to be audited. That I don't have to do it. This is something we miss out as a matter of repetitive. Undisputed statutory dues, you all know, we need to mention over there whatever statutory dues have remained unpaid, but unpaid for more than 6 months as on the balance sheet date. So anything that became payable in March and has remained unpaid, I don't need to mention over here. So unnecessarily don't mention all those items. There is specifically a list of 10, 15 statutory dues which I need to comment upon. And there is a residual clause, other dues. And what we do is we mention wherever there is a problem, and the other due, there are no other dues, and we just leave it. Right? I will suggest in such cases, don't, in your report at least, don't mention other dues as a generic term and leave it. For the reason, the statutory dues, when we are talking about, there are n number of statutory dues, which sometimes we may end up not knowing depending on that specific industry type. And as a result, this can end up become deterrent to what we have mentioned. So specifically list down whatever you want to say. 10 items are there, no undisputed claims pending for these 2 items. These are the undisputed claims which are pending for more than 6 months. Specify it clearly, don't keep it open. Dues recoverable as arrears of land revenue are also to be treated as a statutory due only. But a non-payment of advance tax, unless you find that those advance taxes always paid, the calculations were there, but they specifically did not still pay it. That is a different story. But otherwise, we would say it is just an error in calculation and not a default, right? And a partial delay is also a reportable item. Just by 1 day, if the delays are happening, yes, it is delay, so I have to mention it. And yes, this mention the irregularities in the payment. I am paying all the dues. There are no dues which are more than 6 months outstanding. But every time it is delayed, I need to mention that the payments are there. There are no outstanding undistributed statutory dues, but they are irregular in depositing the same. And in such cases, even partial delay is also to be considered as an irregularity only. But yes, if the statutory dues are disputed by the client, however, they fail to take any action on it, they have not filed an appeal, they have not done anything to prove that they are disputing on it, I will consider it as undisputed. If there were any kind of installment payments, interest penalties required to be paid based on the orders, scrutiny orders, they are also undisputed statutory dues unless I have an appeal in place. As such, materiality not to be considered here unless the delays or values are actually very, very meager. Reporting of delays to be given in general, that is, individual reporting of every case may not be required. For example, you have 12 months wherein every TDS has been paid 4 days late. Every PT has been paid 1 day late. So all those minute level of disclosures not required. You can make a general statement stating 12 months of TDS delayed paid, 4 months of PT delayed paid. Right? And if frequent delays are there, all of those which are outstanding at the balance sheet date for more than 6 months, you have to mention. Amount involved and forum of dispute, even minor amount to be, this is the reporting for disputed statutory dues. Any kind of disputed statutory dues. There, I just mentioned whether paid or not. And here I have to mention every disputed statutory due, whether paid, not paid, etc. And here the amount involved as well as the forum of dispute I have to specifically list down, even if there is a minor amount. Show cause by itself does not conclude that it is a demand. So it will not fall under disputed statutory dues. Unless an order is passed, it is not a statutory due. Tax demands which are set aside are not dues. Referral for reassessment. If the demand is not cancelled, then it is a dispute. Appeal decided in favor of the company is not a dispute unless the department has gone for an appeal. It is an undisputed. It is in the favor of the company, so I don't need to do anything on that. And if there was something wherein the company had to dispute and they have not filed the appeal, however, the time limit has passed, you can still file the appeal with condonation. But the 30 days have passed, I will consider it as a dispute. I have not undisputed statutory due and report it under this clause and not under 7B. More than one dispute for the same statutory due in different period, put different line items. Treatment of disputed dues in accounts is irrelevant. Report even though they have provided for that. Generally, you have found that in other clauses, everywhere they say if it is already reported somewhere, you don't mention it here. But in this case, even if the disputed, undisputed have been taken care in the books of accounts, still the reporting is required. And if you have deposited anything under protest, it will still be considered as disputed and reported under this clause. I will sincerely request the coordinators to let me know whether to continue, because I've already overshooted by 13 minutes. And I will not want the
Yes,
next
ma'am.
to be. Yes.
Yes, ma'am. We can wind up the session if possible, ma'am.
Yes. You can share the PPT because the subject is so vast that in spite of actually running through it very quickly, I could hardly cover 50%.
Yeah, 100%, ma'am. Yeah. We will share the PPT. I will upload the PPT on Women Portal, na?
Yeah, and the question and answers which are there in the test are based on my first half only. So they will be able to attend those.
Yeah.
Okay.
Yes. So over to ma'am. Can we now over to moderator just to give vote of thanks or to ask one or two questions if we receive?
Yeah, there are a few questions on the screen we have received. So shall we take the questions, ma'am?
One or two questions because
yeah. Okay.
Yeah,
Okay.
and if you wish to take it offline, you can share the number and we can take it offline, whatever.
Yeah, we can take one or two questions, then we can give formal vote of thanks. Meera
Okay.
ma'am, can we do like this?
Yeah, I don't know.
Okay.
We'll take one applicability related questions. So we'll take just one questions which are raised by the member. So the question is, subsidiary of the foreign company shall fall under the small company, or if all the two conditions are fulfilled for the applicability of the CARO.
Now, you see, subsidiary of the foreign company, when it is made in India, it will be an Indian company. It is formed under the Indian Companies Act, so it will be Indian company. I have to separately check for whether it is falling under small company, whether it is falling under private company, whether it is a one-person company, whatever. Just being a subsidiary of a foreign company will not exclude it from the checklist of all those checks.
Okay. So that based on the registrations format of the company, we have to consider the applicability of the CARO, right?
Yes, see, even when I'm talking, if this is a subsidiary which is registered under the foreign laws, but again, foreign companies also, this is applicable, right?
Yeah.
If they have a place in India and they are operating it from India, still I need to go ahead and apply CARO to it.
Okay. So rest are some miscellaneous questions. We'll request the member to ask the ma'am directly offline to you, ma'am.
Yes.
Yeah, right? Yeah.
You can drop in a message. Preferably it will be a message. I will revert back as and when I can. I'll definitely revert, but maybe if not instantaneously, I'll revert back later.
Okay, sure, ma'am. Yeah. So thank you so much, CA Meera Joshi, ma'am, for sharing your valuable insights on an intricacy in the CARO. As audit season is going on, so it's really been a value additive sessions for all the members. And so thank you once again, ma'am, for sparing your valuable time and knowledge with all of us. Thank you so much, ma'am.
Thank you. Thank you very much for giving me this opportunity. And sorry, Prerna, for eating up your 15 minutes.
No problem, ma'am.
Bye-bye. Have a
Thank you,
nice
Meera
day.
ma'am, for nice presentations. We have received a lot of appreciation messages from the members.
Thank you. Thank you very much. I hope I was helpful.
Yeah.
Priyanka ma'am, now you can proceed with the introduction of Prerna ma'am.
Yes, good afternoon, all. It's time to introduce another inspired speaker of today, CA Prerna Peshori ma'am. Prerna Peshori is a chartered accountant and international tax lawyer. She is a partner at Peshori Pachori and Jain. She has experience in international taxation advisory, transfer pricing, cross-border transaction advisory, and structuring, deal and startup advisory, litigation, etc. She completed her master's from WU Vienna as Foundation for International Tax Scholar 2019. She has been delivering lectures at various professional forums and has been teaching international tax law to chartered accountants and advanced diploma in international tax UK students. She has been a guest lecturer in several national law universities. She has been selected as 35 future leaders in taxation by TaxScoop. She has authored many papers and book on direct and international taxation. She has been awarded International Research Award by ICL. She is convener of International Study Committee at CTC and at IFA and VCAs. So I hereby request our speaker, CA Prerna ma'am, to please enlighten us on issues involved in Form 15 CA, 15 CB. Welcome, Prerna ma'am.
Thank you, Priyanka, for the warm welcome. I'll just quickly share the screen. Let me know if my screen is visible. Is it visible?
Yes, ma'am.
Let me make it slideshow. Yeah. So now I'm left with, I think, approximately 40 minutes time to cover this particular important topic. And this is something, on and off we have been hearing so many issues around, and most probably I would, like to say that 15 CA and 15 CB, more than the requirement, it's the bank's requirement which comes up. Yesterday, like there was this client who was calling up to me and saying that 15 CA CB bank is asking for the ODI transaction. Now, ideally, that is something which is an exempted transaction from the 15 CACB applicability itself. But if the bank asks, you cannot process the remittance unless and until you fulfill the requirement of the bank. So, as I said, that more than the legal requirement, now this has become a requirement to the bank. Like even if you do a NRO NRE transfer, NRO NRE transfer, then also some banks insist for obtaining the 15 CACB certificate. Whether it is required legally, we'll come to know about it once we start with it. But this is something, as I said, has become like a more banker's requirement rather than the legal requirement in many situations. So before going into 15 CACB, I'll just quickly give a snapshot of section 195. So 195 is the provision which mandates the obligation for deducting the TDS whenever the payments are being made or the remittances are being made to a non-resident taxpayer, non-resident payee. So in that particular case, you have most probably the applicable section is 195. There are other sections also applicable, which is 192 in case of payment of salaries to a non-resident employee. In that particular situation, 195 is not applicable, it is 192. There are other sections like 194 LC, LD, which are applicable on the interest payment, on the mutual funds, and there are certain sports person who are non-resident. For them, 194E, so on and so forth. There are different sections which are applicable. But any payment which does not have a specific TDS obligation, that is subject to section 195. And that's what we are majorly going to look at it, from where the 15 CACB requirement also comes up. So now who is covered under 195? So any person is covered under 195 who is responsible for paying to a non-resident. So this means it would also include a non-resident to non-resident payments as well. It is not necessarily only when the resident is making payment to another non-resident where the TDS obligation arises. The TDS obligation also arises when one non-resident makes payment to another non-resident as well. So there's no requirement that the non-resident who is making a payment should have some amount of presence or should have a permanent establishment or business connection. There is no need of that. Any non-resident making payment to another non-resident, if the other non-resident has a source of income over here, then in that particular case, the TDS obligation arises on the payer. Now, what are the transactions which are covered over here? As I said, any other sum which is chargeable to tax, which is not covered elsewhere. So, as I said, that there are other specific sections like 192 covers salary, 194 LC, LD covers the interest on bonds and the rupee denominated bonds which are there. There are 194, 196 payments which are there in terms of the income from GDRs, offshore funds, non-resident sports person under 194E. So excluding those, any other sum which is chargeable to tax is covered under section 195. Now, when I say any other sum chargeable to tax, what do we understand by any other sum chargeable to tax? So let's take an instance, let's say for example, where a particular person has sold the property, where a non-resident seller has sold his property in India. Now, at that point in time, the buyer who is there, who is making the payment of the sale consideration to the non-resident seller, in that particular case, what is the obligation of the TDS on? Whether the TDS has to be deducted on the capital gain amount or whether the TDS has to be deducted on the sale consideration amount which the buyer is making the payment for. So in that particular case here, if you look at the provision, it says any other sum chargeable to tax. So any other sum chargeable to tax implies that the sum which is chargeable to tax only on that amount the TDS has to be deducted. Now, why is this very important? Because when you are issuing a 15 CB for that, at that point in time, you also need to give a certification that this is not on the sale consideration, but on the capital gain amount. Now, as a buyer, how would you come to know what is the capital gain amount? Because there are quite a number of problems. You would not have the value of the purchase of property when the seller would have purchased the property. We do not know the property value. We do not know the year in which he would have purchased it, whether the seller is putting up funds in some other property to claim the exemption under 54 or any other bonds in which he is investing, let's say RECL bonds or NHAI bonds in which he is investing, and therefore he would claim 54 EC. We do not know about that information. So as a buyer, how will I know the capital gain amount which is chargeable to tax? So mostly in terms of the requirements, what the buyers usually do is they deduct the TDS on the sale consideration to avoid any consequences in future because they do not know the capital gain amount. But what the seller can do is seller can apply for the lower deduction certificate under section 197 and take the certificate from the income tax department that this is what the rate should be applied considering the capital gain amount. And this particular certificate is issued to the buyer who would then deduct the TDS at the lower deduction rate which is given in the certificate issued to him. So this is a possible scenario where, in case the buyer does not have access to the capital gain amount, they can insist the seller to take the lower deduction certificate. Alternatively, they can deduct on the sale consideration itself. So this is where, but the requirement of the law is sum chargeable to tax. If you know what is the capital gain amount, if he produces the certificate, then of course you can go ahead and do that. Now, in case when it says, let's say, for example, the exports are made, right? Or for that matter, let's say, for example, the imports are made. Now, the payments for the imports which are there, whether this is on the entire imports, the TDS under 195 has to be deducted, the answer is no. It is on the sum chargeable to tax. Now, again, you would ask how the profit determination you would know on the purchases that you're making. So, again, for that, we have an option to claim the lower deduction certificate under 197, 195.2 and 195.3. So that is something where it is on the amount which is or the sum which is chargeable to tax. Now it is 195 is applicable at the time of payment or credit, whichever is earlier. Unlike other sections of TDS where there is a threshold which is given. Let's say, for example, under 194J, you have more than 30,000, under 194C, you have more than 1 lakh. But here under 195, there is no threshold, meaning on the very first transaction itself, when you are undertaking, you have to deduct the TDS. Now, what is the TDS? The TDS rate is not mentioned under 195. It is at the rates in force. Now, what do we understand by the rates in force? Rates in force are defined under Section 237 of the Income Tax Law, which says that the rate under the Income Tax Act or the rate under the tax treaty, whichever is beneficial to the taxpayer, shall be taken. So, let's say, for example, as a payer of the remittance, I need to check the rate under the Act and the tax treaty to decide what is the applicable rate. And even when you issue the 15 CSEB certificate, it is very important at that point in time to check the rate under the Act and under the DPAA to identify what is the rate, which is the rate in force, which can be called as rate in force for the purpose of the 195. Now, having said that, as I said, that in terms of the deduction of the amount over here. Now, in case, let's say, for example, for the rate of the TDS, whether we need to add any surcharge or cess to this particular amount, the surcharge is not to be added to the TDS rate, but of course, the surcharge can be added to the rates which are there under the Income Tax Act. If you are adopting a DTAA rate, then you don't need to add the surcharge or the education cess to it, and there are supporting decisions in that particular context. Now, what about if the payee does not have a PAN? In that case, there is a trigger of Section 206AA, which says that the TDS shall be deducted at the rates which are the higher of rate which is there under the Act, or rate in force, which is the rate under the Act or the treaty, whichever is beneficial, and the 20%. So in that particular case, you have to deduct at the highest of these three rates. But there is a relaxation which is given under Rule 37 BC in case of the non-resident payee if they furnish the TRC and their tax identification number and their contact points. Then in that particular case, in case the payment is for the interest, royalty, FTS, capital gain, then in that particular case, the 206AA will not be applicable. So in that particular case, you have that relaxation that even if you do not have a PAN, but you give the TRC and the tax identification number, then in that particular case, you are not required to obtain the PAN, and 206AA will not be applicable in that particular situation. Now, one more important point here is that what is the relevance of the TRC now? Now, tax residency certificate is basically the certificate which is issued by the tax authorities of the other country, which gives the details about the taxpayer that this particular taxpayer is a resident of so and so country. So this is considered as a valid proof of the tax residency. Along with that, in case the TRC does not consist of all the details which are prescribed, like the status of the person, whether he's an individual, whether it's a company, whether it's a partnership firm, the nationality, the tax identification number, the period of the residential status, then in that particular case, Form 10F is required. So if the TRC does not contain all the details, then you need to also obtain the Form 10F. Now, Form 10F is required only in two situations when the TRC does not consist of all the details. Let's say, for example, there are several TRCs which do not mention the year for which they are issued. Then in that particular case, we need to also obtain the Form 10F. But if the TRC has all the details which are required, then in that particular case, the 10F form is not required. Additionally, 10F form is required only when you are claiming the treaty benefit. So it is not required when you are going as per the Act. 10F is not mandatory when you are going as per the Act, because TRC is required only in the situations when you are claiming the treaty benefit. 10F is also in the similar circumstances required only when you are claiming the treaty benefit. If you are not taking any treaty benefit, no 10F is required. Now, when you are saying that you have to obtain 10F now, earlier Form 10F was a self-certification form which you used to be given manually, physically signed. But now Form 10F has been made online. It has to be obtained online on the income tax portal. To create the or to download or fill the Form 10F on the income tax portal, you need to first create your login credentials. For login credentials, you know that your login is always the PAN. So which means that Form 10F has now made the requirement of PAN mandatory. So whereas 206AA was not requiring you to obtain the PAN by having the relaxation, sorry, 206, not 206AA, for Rule 37 BC has given you the relaxation in terms of that even if you may not obtain the PAN, 206AA will be not applicable in this situation if you provide the TRC. But for the purpose of obtaining the Form 10F, you need to obtain the PAN. So for that purpose, if you have to download Form 10F, you need to obtain PAN, without which you would not be able to download or fill the Form 10F. So e-furnishing of Form 10F has become mandatory. But for that, as I said, you need to obtain the PAN. However, there's an exemption for certain taxpayers that the PAN is not mandated for them, for the AIFs and all. So for them, there is no mandate to obtain PAN, but at least for the other taxpayers, PAN is going to be mandatory to download Form 10F. Now, when you issue the 15 CACB, at that point in time, it becomes very crucial that you take these particular forms, the TRC, the Form 10F. But what happens is sometimes the TRC is not available at the time of deduction of TDS. So then in that particular case, what do you do? Whether the TRC non-availability results in denial of the treaty benefit. So ideally, there are judgments around this particular point. So there is a recent judgment of the Mumbai Tribunal which says that delay in furnishing the TRC is justifiable. So what in these judgments has been held as that even if you do not have the tax residency certificate at that point in time, due to certain operational reasons, due to certain reasons which are beyond the control of the taxpayer, that should not lead to the denial of the treaty benefit altogether, because the treaty benefit is based on that you are a resident of so and so country. Now, obtaining the TRC as a proof of the residency is a procedural requirement, and a procedural requirement should not create any kind of impediment for the granting of the treaty benefit. And therefore, in many situations, the courts and the tribunals have allowed that even without the TRC, where there were justified reasons for non-obtainment of the TRC, or there were justified reasons that there was delay in obtaining the TRC, then in that particular situation, the treaty benefit has been granted. Now, there are other situations in TRC that the tax year is different from the calendar year, that you obtain the TRC from the tax authorities, but those tax authorities have issued the TRC for the calendar year. And let's say, for example, you are now looking at the in the month of March, you are issuing and they have given you the TRC of the past year. So then how do you go about it? So then in that situation, see, you need to tell the client to obtain the TRC, apply for the new TRC for the current year, but that does not halt the payments which are to be made, because nobody is going to wait for the payment to be made until the TRC is issued, because TRC takes a longer time, maybe sometimes 3-4 months, maybe longer than that. So then in that situation, as a CA, how would you go about it when you're issuing the 15 CACB? Ideally, you take a declaration from the payee that you would obtain the TRC, rely on the last year's TRC, and then go ahead and issue the 15 CACB. But at least take a declaration in that context that you are in the process, or at least ask them to make an application and issue you the application draft that they have submitted, so that at least you have a proof that they have already made an application in that respect. So that is something which is you have to be very, very careful. Also, there is another issue in respect of TRC, is that TRC sometimes is not in English. TRC issue is not in English. It happens usually with China, with Taiwan. So in that particular situation, what do you do? So in that particular situation, again, you ask for a translated copy and a certified translated copy of the same, because otherwise you just cannot understand and rely on the TRC, which is in the different languages. So you ask for a certified copy or just certified translated copy. Then there are certain countries with no TRC. So if there is no TRC which is there in a particular country, then how do you go about it? Then in that situation, it is difficult to give the tax benefit or the treaty benefit without having any TRC in effect, because these countries, but they could have, other requirements. Let's say, for example, instead of the TRC, they may have some other certification which could be possible. So, depending on how those certifications are, whether those show you the proof of their residency, you may rely on that, but it's something which is a difficult situation in terms of the countries with no TRC at all. So then after that, I think some common issues which are there around the, of course, we'll get into Form 15 CACB, because otherwise we have a very shorter time, and then of course we'll discuss the common issues around that. So the remittance certificate requirements come under Section 195(6) of the Income Tax Act, which says that any person responsible for payment of any sum to a non-resident, whether or not chargeable to tax, shall furnish the information in the prescribed manner. Now, as far as the certification is concerned, the 195(6) section says that whether or not sum is chargeable to tax, you have to furnish the information. Now, if you read 195(1), it says that the TDS has to be deducted only on the sum which is chargeable to tax. But whereas for the remittance certificate requirement, you have to report these remittances whether or not the sum is chargeable to tax. So the information has to be furnished in the prescribed manner, which is given under Rule 37BB. Now, Rule 37BB, the operational provision of that says that the information has to be furnished on only the sum which is tax. So, ideally, there is a conflict between the Act and the rule, because the Act says that the information has to be reported even if the sum is not chargeable to tax, whereas Rule 37BB says that the information has to be reported only when the sum is chargeable to tax. So, what shall prevail? Of course, the Act will prevail. And that could also be witnessed through the Part D of the Form 15 CA, which says that where the remittance is not chargeable to tax, then in that particular case, you still need to report the information under Form 15 CA, unless other than there is an exempted payment. So Form 15 CA is the reporting requirement by the taxpayer himself. It's an online form. You need to file it online on your e-filing portal. So there are four parts which are there under Form 15 CA. The part A is where the remittance or the aggregate of remittance does not exceed rupees 5 lakh during the financial year. Part B is in a situation where the remittance is exceeding 5 lakh, but in that particular case, you have obtained a lower deduction certificate under 195(2), 195(3), or 197. Then you need to fill the Part B. And you have Part C, where you have to obtain the 15 CB. So where 15 CB is also obtained, 15 CB is the CA certificate which is to be obtained in case the remittance is a taxable remittance. So if you have a taxable remittance, then in that particular case, you need to also obtain Form 15 CB. And if you have obtained Form 15 CB, then in that particular situation, you need to fill Part C. And where the remittance is not at all chargeable to tax other than the exempted payments, then in that particular case, the information has to be reported in Part D. Now, what are these exempted payments which are there? So, Indian investment abroad in equity capital, there are a list of 33 items which are given under Rule 37BC2 itself. So, Indian investment in the debt securities, in the subsidiaries, the investment in the real estate. So any remittances which are made for, let's say, for example, I was talking about the investment in the ODI or the overseas direct investment which is there. So that is something which is the Indian investment abroad in equity capital. So for that, there is no reporting. It's an exempted transaction. Similarly, any investment made in debt security or in the wholly owned subsidiaries and the branches, or in the real estate, if you're buying a property outside India, then in that particular case, 15 CACB is not required to be obtained. Or any loans extended to non-residents, advance payments which are made against the imports, for that also you don't need to obtain 15 CACB. Or even payment towards the imports for the settlement of invoice, you don't need to obtain 15 CACB in those situations, because it is an exempted payment. So there are multiple things which are given over here, or imports which are below 5 lakh for the use of by the ECD offices, payment for operating expenses of Indian shipping companies, then operating expenses of the airline companies operating abroad, booking of passengers abroad, remittance towards business travel, then travel for the other basic travel quota, pilgrimage, medical treatment, education, postal services, then freight insurance, construction of projects, then payment for maintenance of office abroad, remittances by Indian embassies or foreign embassies, remittance by the non-residents towards the family maintenance, personal gifts and donation, and donations to any kind of donations which are made to the government or charitable institutions, towards the taxes, refunds which are there on export, for all of that, there is no Form 15 CACB required. So in case your payment falls under any of these 33 listed items, you don't need to follow file Form 15 CACB. Even 15 CA is not required by individual for carrying out the transaction under the liberalized remittance scheme. So if you're making any payment under the LRS scheme, you are not required to obtain the Form 15 CACB. So these are the exempted transactions for which 15 CACB is not required. Now, there are multiple issues that we would now discuss. So, first of all, the problem with Form 15 CACB is that there is no facility of correction and withdrawal once you have filled the Form 15 CACB and uploaded it. And this is to be submitted prior to the remittance. The remittance can be made to a country different from the residence of the payee. It is not necessarily that the bank account has to be in the same country. The residence of the payee could be in country A, and the remittance can be in entirely different country B. Now we'll discuss about certain issues which are cropping up usually in the Form 15 CACB. Now let's say, for example, if the income is taxable under the Income Tax Act, but which is exempt under DTAA. Let's say, for example, we are talking about the fees for technical services. Now, fees for technical services is taxable under the Income Tax Act under Section 917. It is taxable. If the payer is a resident of India, the source is in India, it is deemed to accrue or arise in India. But when you go to, let's say, for example, India-US tax treaty, then in that particular situation, you would have a situation where you have the make available test. Now, if the service provider does not make available the knowledge to the service recipient, then in that particular case, the FTS shall not be taxable in the source country because the make available test is not satisfied. Now, if the make available test is not satisfied, the FTS is not taxable in the source country. Now you have a situation wherein it is taxable, the FTS is taxable as per the Act, but not as per the DTAA. So now, how do you report this transaction? Do we report it in Part C by obtaining the Form 15 CB, or do we report it under Part D that the payment is not chargeable to tax? Now, here one can take a view that it is not chargeable to tax because it is exempt under the DTAA and therefore it does not fall under the charge of Section 4 itself, and therefore we should report in Part D. But ideally, see, the situation here is that a CA certificate is required in order to claim any kind of exemption which is given through the tax treaty. Because if you go through the Part C, the Part C has those relevant columns in terms of that what is the taxability which is arising under the DTAA. So in case you are claiming any exemption under the DTAA, ideally you need to fill Part C and not Part D. Because if you have a situation that, okay, based on a that, okay, this is what it is, that it is to be exempt under treaty, only then the income tax officer would have some amount of reliance on your claim. So in case you are claiming any kind of exemption, report it in Part C and not in Part D. But let's say, for example, there is also a situation that you have sold the shares in India. Now, the shares in India, when you sell them, you can have a loss arising on the sale of shares. Now, if there is a loss arising on sale of shares, if there would have been a capital gain, you would have ideally reported in Part C. But now, if there is a loss, there is no income chargeable to tax, then whether you would go for Part D or you would go from still Part C. So ideally, again, the view you can take is that there is no income chargeable to tax, then we should go for Part D. But at the same time, the loss which is there is again subject to a computation. So if you have a CS certificate, that makes it more authentic, so authenticated. So therefore, I think you should go for Part C and not Part D. Now, another issue which arises in terms of the 15 CACB is the credit card transactions. Nowadays, if you see, most of the transactions are taking place online. There are your clients, there may be your clients who are purchasing the software, purchasing the online tools, purchasing online subscriptions, and making directly the payment through the credit cards. Now, if they make directly payment through the credit card, ideally the question arises that whether they had to obtain Form 15 CACB. They would never tell you, only when you do the audits or when you come to file the tax return, you would come to know that yes, they had made these payments online to a non-resident and they have failed to obtain Form 15 CACB. So then in that situation, what should be done in that particular case? Whether 15 CACB is required or not. Because once the transaction is happening through the bank, then in that particular case, yes, the bank would certainly ask for it. But if the transaction is happening online through a credit card payment, whether you were at the first place required to file the 15 CACB, yes, you were required to file the 15 CACB. Now, if the transaction is subject to the equalization levy, then it becomes exempt from the income tax law, and then you would not have any reporting requirement under the income tax law because the transaction has itself been exempted under the income tax act, but still you would have to file at least form 15CA part D. So even if you are subject to equalization levy and the transaction and the particular income becomes exempt under 1050 under the income tax act, but still there is a reporting requirement under 15CA part D, because that's what the act says you, that whether or not the sum is chargeable to tax, you need to fulfill the reporting requirement under the 15CA. So you still need to file form 15CA part D even if you are making the payments online, and if it is subject to equalization levy, still you are required to submit the information in part D. Now, in case you fail to submit the information under, or you fail to file the form 15 CACB, or for that matter, you submit the incorrect information, you file part D where you are required to file part C, then in that particular case, there is a failure to furnish results in or inaccurate information results in the 1 lakh rupees penalty, which is under section 271I, which is very huge. And on CA also furnishing the incorrect information in the certificate, there is a penalty for each such wrong certification, which is 10,000 rupees per certificate if you have issued wrongly, which is under 271J. So if you can see, the penalties are very, very onerous. So in that particular situation, it is better that you give this information instead of missing to avoid it, or missing to give it, because then it could have the penal consequences. Now, what are the other issues which arise in terms of the 15CA? So I would take up certain common tax issues which are there first. So TDS on purchase of the goods. As I said that in case you are importing for the import outside India, then there is no business connection constituted in that case, because that is considered as an exclusion to the business connection and there would not be any TDS. But if you are doing a purchase for sale in India, then in that particular case, whether you are required to deduct the TDS, the answer is yes, you are required to deduct the TDS under 195. Now, what would be the TDS amount? Whether it would be on the entire value of the imports or whether it would be on the profit. As I said, 195 says that it has to be on the sum which is chargeable to tax. Now, what is the sum chargeable to tax? For that, the payee or the payer needs to make an application under 195.2, 195.3 or under 197 to obtain the lower deduction certificate from the tax officer, which would be issued to the payer who would be deducting the TDS. In case it is not obtained, then of course you will have to deduct on the purchase value which is available to you. Now, in case of the purchase transactions, please obtain the declaration in terms of having no business connection, no significant economic presence in India, and no permanent establishment in India. So these three declarations needs to be obtained from the payee to demonstrate that you do not have a PE business connection or SEP in India. Now again, in case of the purchase of services, the same consequences would be arising, but that would be of course classified as the fees for technical services, and for that you need to check the make available clause, the most favored nation clause, in case it is present in the protocol to the tax treaty. These days there are also issues around the most favored nation clause. The CBDT has issued the notification that each protocol has to be separately notified. Unless and until the protocol has been notified, there cannot be the applicability of the protocol to the tax treaty. For example, the recent one which was notified was of Spain. So they had specifically notified the protocol, and this has also been upheld by the Supreme Court. So please see in the tax treaty that whether there's a protocol which covers the most favored nation clause in any particular treaty, then you can borrow the treatment from the favorable treaty into this particular treaty with regard to the FTS rate or the scope of the FTS. If that other treaty has the make available test based on the MFN, you can borrow in this particular DTAA as well. Export commissions, generally there are questions around that whether export commissions are taxable. Yes, the export commission could be taxable depending on what it is, what is the nature of the export commission. So if the export commission is paid for the business outside India, then in that particular case, it falls under the exclusion of the FTS clause that it is for the business carried on outside India and it may not be taxable. However, if it relates to the Indian operations, then in that case, it could be classified as FTS. Then again, for royalties, you need to check whether the software purchases which are there, whether it can be classified as royalty under the Act, under the tax treaty. There is an engineering analysis judgment of Supreme Court, whether it has been held that under the tax treaty, purchase of software does not constitute the royalty. In case of the end user license agreement and the distributor agreement, where there is no addition made to the software and it is a back-to-back resale arrangement which has been there. In case of the digitized transaction, in case of database subscription, you need to check for the applicability of the equalization levy. If the transaction is subject to equalization levy, it would become exempt under the Income Tax Act. But still, as I said, you need to file 15 CA Part B. In terms of FTS, you need to check whether whether it is a technical service, managerial service. You need to check whether there is a make available test if present under the DTAA, whether you are satisfying the make available test or not. All those conditions need to be checked. Then there are issues around the reimbursement. For the reimbursement services, you need to check whether it's a case of a pure reimbursement or it's an allocation of the shared cost. Then in that particular case, whether there has been any markup. If there is no markup on that and there are supporting invoices, back-to-back arrangement is there, that there are supporting invoicement which makes it a pure reimbursement, then there is no TDS on that particular thing. In case there are payments in kind, which is mostly now happening in terms of the Bitcoin purchases, then in that particular case, the withholding tax obligation is still required on the payments in kind as well. On the interest earned by the non-resident, on the NRO account, there is the requirement of the TDS on the interest which is there. NRE and FCNR interest are exempt, but that should be paid to a non-resident who is a non-resident as per the FEMA rules, not as per the Income Tax Act. This particular person who should be a non-resident under FEMA and not a non-resident under income tax. There's a difference between the non-resident definition under the Income Tax Act and under the FEMA. Then on the salary payments, again, you need to check whether the salary is earned by the non-resident as per the DTAA, whether he has rendered the services for the specified number of days under the DTAA. These days, there are not many taxpayers receiving the ESOPs also. So what is the taxability of the ESOPs? You need to check around that. Based on that, if the remittances are made for the purchase of the ESOP, whether there would be any TDS obligation, answer is no, because it's just for the purchase of the ESOP. It is only on the sale of the ESOPs that the taxability will be arising in India. If the ESOPs are given in India, I'm not talking about the foreign ESOPs, I'm talking about the Indian ESOP, but only when the employment is exercised in India. So you need to check for how many days the employment is exercised in India, because there is an exemption under the tax treaty. Now, transfer from the NRI's own NRO account to NRE account, what I was talking at the start of the lecture was that whether in that case there's a TDS on that, the answer is no, because it's from one pocket you're transferring to another pocket. It's from payment from one account to another, so there's no TDS requirement. But the banks insist on Form 15 CACB. So as a chartered accountant, you need to find out before issuing 15 CACB that what are the source of the funds lying in NRO account, whether there is any income comprised therein in that NRO account, what are the prior years income tax returns suggesting, whether the TDS has been deducted on the income which is reflected in the NRO account. So based on that, you can identify that whether there was any income element which was involved in the NRO account, whether the TDS was deducted in that while the amounts were credited, whether at that point 15 CACB was taken. And once you have that kind of comfort, you can issue a 15 CACB on the basis of that. When there is transfer from NRO to NRE account, ideally the law does not require issuing any 15 CACB in that situation, but there are certain banks which insist on taking that. Then in case there are third party transfer to the NRE account, in that particular case, yes, a payer would need to obtain a 15 CS certificate because it's a remittance which is coming into the NRE account directly from a third party. And in case there is 197 certificate which is taken, then you have to fill the part B. Then in case there are transfer from third party to the NRO account, so in that particular case, there is generally no requirement to obtain 15 CACB in that case because it's a domestic transaction. NRO account is the remittance which is remaining in India. The remittance is not going outside India. In the case of NRE account, yes, the remittance is considered to be going outside India, wherein the 15 CACB is required. However, under 195(6), the information is to be furnished irrespective of whether the amount is remitted outside India or not. So in that case, ideally the bank may not insist on the 15 CACB when the amount is credited to NRO account, but as per 195(6), since the amount is remitted to the non-resident, you should report it in Form 15CA at that stage itself. Otherwise, you will have to then later on report it once you transfer from NRO to NRE account. Now, what is the conversion rate which has to be considered? This has to be as per Rule 26. So, the rate has to be considered as on the date the tax is required to be deducted. And on that date itself, you have to consider the conversion rate. So, Rule 26 gives you the conversion rate which is there. Now, application for the lower deduction certificate, I'll just give you a quick snapshot. So, 195(2) is the application by the payer, 195(3) is by the payee, and 197 is again by the payee. So, 195(2), a payer can make an application for the determination of the tax amount or the TDS to be deducted on the remittance to be made. Now, this is appealable also in case you receive the TDS certificate that this is to be amount or this is the rate on which the TDS has to be, as per which the TDS has to be deducted. This could be appealed before the CIT also. Now, the application has to be made on a plain paper and the order will be passed then by the AO. Then, in case of the 195(3), it is only applicable for certain non-residents, which is the foreign company having the Indian branch for interest or any dividend income, or foreign company having any Indian branch for any other sum, which is other than interest or dividend. So, basically, 195(3) can be only made by a foreign company having the Indian branch. They can use this particular provision to obtain the lower deduction certificate. Then you have 197, which is generally used by every payee in case of the property transaction, at least that they apply, or even in the case of the business profits, they apply under 197. So in that case, you can obtain the lower deduction certificate. It is entirely now online with the application is to be made under Form 30. So based on that, you can get a lower deduction certificate. But under 197, this is not appealable. Only the petition can be filed. So what are the other important points that you need to consider in case of the Form 15 CACB? You have to see the agreement copy. You have to conduct the due diligence. You have to see what are the contracts saying, what are the agreements saying, and then decide the tax implication based on the reading of the agreement. So do not just go by the invoice which is being paid. Examine, ask for the underlying agreement so as to decide the nature of the transaction and accordingly decide the taxation treatment. Then you need to identify the residential status because only when a person is a resident of a particular country, he would be able to claim the treaty benefit. So for that, you have the Form 10F, you have the TRC, which is to be obtained TRC, you have to obtain, and in case the TRC does not have all details, you have to obtain Form 10F. So now only when you are claiming a treaty benefit, I said that you have to obtain TRC and 10F. If you are not claiming the treaty benefit, no need of TRC and 10F. 10F, for obtaining 10F, you need to have a PAN. The payee needs to have a PAN to obtain the Form 10F. Also take a declaration of the proof of beneficial ownership. You can just take a declaration. Although in many of the judgments it has been held that TRC is a valid proof of even the beneficial ownership, but it is now pending before the Supreme Court that whether TRC can be considered as a valid proof of beneficial ownership. But at least for residency, it is. Then obtain a no P, no business connection, no SCP certificate also from the payee because this is very important in case you are, like how will you decide that whether the payee has a PE or not, whether the payee has a business connection or not. You do not have full idea of the facts which are there. So in that case, it's better to take a declaration and rely on that, because otherwise it could, lead to a wrong results in case you do not take that and just rely on your own judgment, because you may not be privy to all the facts of the pay. Then identify the legal status of the taxpayer, whether it's a partnership, whether it's a company. Then ascertain the nature of the income and characterize it accordingly, whether it's FTS, whether it's royalty, whether it's a business income, because accordingly you have different tax rules, different tax rates for that. And look into the applicable tax treaty. You need to check, as I said, the protocol to the tax treaty to identify if there is any MFN clause in the tax treaty so that you can take a benefit. You need to look into the limitation of the benefit clause, because if you have the limitation of the benefit clause getting triggered, then in that particular case, you would not be able to claim the treaty benefit at all. Then you have also changes happening due to the MLI. So please look into the synthesized text wherever it is available. If it is not available for a particular treaty, look into the MLI changes that have been made to the tax treaty, because that would be resulting in the sometimes non-applicability of a provision itself. So these are some points that you may check. So whenever you are giving any 15 CACB, you have to safeguard yourself, because at the end you are certifying a particular taxability of a transaction. So you have to be sure about that how the taxability is going to happen. Otherwise, as I said, there's a penalty of 10,000 rupees for wrong certificate which is given. So I think that's it from my side. I have completed on time. I think if you have any questions, we'll be able to spend time now on questions.
Yes, ma'am. Apurvi, ma'am, over to you.
Yeah. Thank you so much, CA Prerna ji, for a wonderful session. So moving to our question answer rounds. So we try to cover more and more question as there are a lot of questions.
Sure.
So first question is from the Vritika Sarvagaji. If treaty is not applicable, are tax rates under section 115A 20% or 10% for royalty or FTS?
Sure. So it is 20% if the treaty is not applicable. It has been revised to 20% from 10%. 10% was earlier. Now for the royalties and FTS, it is 20%.
Okay, thank you. Now moving to the next question. It is from the Kalpana ji. Whether TDS required to be deducted on commission paid to Booking.com, Netherlands-based companies having a PAN in India given TRC and at a server located outside India.
Sure. So Kalpana ji, you have to, so Booking.com is basically the intermediary company which is facilitating the booking of the holidays or booking of hotels and is acting like an intermediary between the hotels and the customer. Now, as far as the commission which is earned by the Booking.com, you have to examine in terms of the agreement, which is the end user license agreement, which is available on their portal very easily. So you can download and see that whether it gives any right. So, like to my understanding, it does not give any rights. It cannot be classified as royalty. This is also not FTS because this is not giving any kind of technical services. So therefore, it should be outside the purview of the royalty or FTS. Now, it has to be examined on the basis of that whether it is a business income, but the equalization levy should be applicable on this instance because the Booking.com can be classified as a non-resident e-commerce operator, which is facilitating the e-commerce supply of goods and services online. So in that particular case, the equalization levy 2.0, which is at the rate of 2%, should be applicable. Now that has to be paid and discharged by the e-commerce operator himself. So as a payer, you do not have any liability on the same. So therefore, in that situation, ideally, there is no, and once equalization levy is applicable, there is no requirement because it will become exempt under the income tax law. So there is no requirement of TDS under the income tax law since it's an exempt transaction under 1050. So therefore, income tax should not be applicable on this case.
Thanks. We are moving to next question. The question is from Parnaji. I have a question regarding TRC. For example, the service is re-entered in February 24. The TRC expires in February 24, but the payment take place in April 24. So is the TRC valid for making the payment in May 24?
Sure. So, TRC is valid at a particular point of time when you are issuing your certificate. You need to look on that particular date whether you have a valid TRC or not. Now, this is a very common instance that the clients, whenever they ask for their pay to give the TRC, they may give the TRC of the last year itself. They may give the TRC which is due to expire sometimes, as in your case. So then, in that situation, what needs to be done? So TRC is a proof of residency. Now, you may be a resident at this point in time till February, it is fine. But after that, you may shift your residency also. The government also may not be privy to it. So ideally, the better thing would be to ask the payee to give the TRC of the April itself, which would not be possible in February when you would be issuing the remittance certificate, but you can at least ask them to make an application and submit you the application form as I highlighted, so that, and whenever the TRC is received by them, they would submit to you. So you can take a declaration around that as well. So that will help you out.
Okay. So the next question is by the Bharti ji. Please explain MFN.
Sure. So, Bhartiji, MFN is the most favored nation clause which is present in the tax. I'll just give an example. Let's say, for example, India and Netherlands is there as they have a tax treaty, right? Now, this has a most favored nation clause which is found in the protocol to India Netherlands tax treaty, which says that if tomorrow India signs a favorable tax treaty in terms of the reduced tax rate or a reduced scope of or the reduced scope of the definition of a particular item, which is usually around FTS, royalty, interest, and dividend, then India agrees with Netherlands that Netherlands can import that provision in the India-Netherlands treaty. So let's say, for example, India, Lithuania has a beneficial dividend rate which is 5%. India Netherlands has a dividend rate of 15%. And now India Netherlands has an MFN clause. So relying on the MFN clause, Netherlands can say that India should apply the 5% tax rate from India, Lithuania and not the 15% because India has granted this lower tax rate to other country also, which is the OECD member country. So this is what MFN clause is, but around that there are multiple issues. So these days MFN clauses are generally not available without the CBDT notifying them separately by way of notifying the protocol. So there are many issues around that, and this is something which is pending before Supreme Court.
Thanks. Perfect. Okay. So next question is from the Anupama ji. Suppose a US entity issue an invoice for professional services to an Indian company client. The US entity has a subsidiary in India and services to the client are provided by an Indian subsidiary. Will the client need to file a Form 15CA while remitting a fees to the US entity?
Can you just please repeat? I think I lost in between. Yeah.
Okay, no problem. So, suppose a US entity issue an invoice for professional services to an Indian company as a client. The US entity has a subsidiary in India and services to the client are provided by an Indian subsidiary. Will the client need to file Form 15CA while remitting a fees to the US entity?
Understood. So in this case, see, you're remitting to the US entity itself, even though the services are provided by the Indian subsidiary and the contract is with between the Indian company and the US company. So yes, you should be required to be filed the 15CA and 15CB form because the payment is being made to the US entity at the end. It's irrespective of who is rendering the service. It's important. What is important is to whom the remittance is being made, A, and with whom you have the contract.
Okay, thanks. I think we are running to the shortage of the time. We have lots of question over there. So I request you to the participant will try to reach out through the mail and try to resolve your queries by the Prerna ji soon. So now it's we are running the shortage of time. We would like to wrap up all our session and we'll close this session, wrap up this session with a vote of the thanks. I start my vote of thanks to the Preeti ma'am, Kimisha ma'am, all the speakers, very who provide us the very valuable sessions. and all the technical staff for such a wonderful assistance, and all the moderators, and all especially special thanks to all the participants, who give us the motivation and give us the chance, to speak and to enrich our knowledge. So thanks everybody.
Manish, please wind up the session.